there's a structure. It's been set up so that for the investor, it looks like a stock and has all the properties of an individual stock in terms of its tax structuring, which means, typically if you buy it and hold it for more than a year, it's taxed at, your capital gains rate rather than your ordinary income rate. That's a great tax loophole to have. ETFs are also advantaged relative to mutual funds in that they have the ability to wash the capital gains in the securities underneath. And so therefore you don't get, in the vast majority of ETFs, there are not capital gains distributions, even for products that have moderate turnover. There are not capital gains. They're typically not capital gains distributions that you see in other funds. And so what that means is you pay the taxes when you want to pay the taxes, not when the manager, has redemptions or when the manager rebalances. That's all very advantageous. And so it's just, and not to mention the fact that it's transparent and it's liquid and it's a 40 Act product, that's SEC registered and at arm's length and, has independent custodians and independent board, which, for hedge funds, how many times are you looking at hedge funds and you're saying, well, what's the probability of fraud? I'm not saying that there's lots of fraud, but that is a thing you have to worry about. Well, if the security in an ETF, if the securities are held by an independent institution, I don't touch the money, right? I can't touch the money. It's an independent trust that holds the money, not me. It's an independent trust that, that is highly regulated by the SEC. That's very advantageous from a consumer standpoint in terms of the risk of fraud or abuse that comes from a manager.
Yeah, I've always felt if you could take your total portfolio, however way you invest, and put the whole thing inside of a single ETF, you'd be in great shape because you're basically putting that tax efficient wrapper around. This is obviously for taxable investors. You can put that tax efficient wrapper around the total portfolio. Obviously, that's very complicated, not easy to do. So short of that, you can try to put an ETF wrapper around those return streams that make sense.
Most people think about ETFs as like low cost index funds because that's basically how they started. But the tax efficiency is actually the best with moderate turnover portfolios because you don't have to take the capital gains in and out. All right, you can put those all into a single wrapper and only basically take the taxes, only pay the taxes at the point of sale. And so actually the ETF structure is more tax efficient, better for actively managed strategies than it is even for passively managed strategies, which is pretty neat.